You finally decide to turn a hobby into a side hustle to make your retirement a little more comfortable. But instead of extra breathing room, you inadvertently trigger a hidden IRS mechanism that legally confiscates a massive chunk of your Social Security checks. The IRS knows that most retirees picking up gig work, consulting, or selling online are completely unaware of this trap, and it is costing older Americans millions in avoidable penalties and lost benefits every single year. But there is a very specific sequence of steps you can take to shield your extra income, and I am going to show you exactly how to keep your money in your pocket where it belongs. Over the past decade of examining tax strategies and retirement pitfalls, I have seen far too many hardworking people step on financial landmines they never even knew existed. You worked your entire life to finally clock out, and now, with inflation eating away at fixed incomes, grabbing a little extra cash seems like the smartest thing to do. But retirement income does not play by the same rules as your old regular paycheck. Today, we are going to walk through the exact mechanics of how extra cash can accidentally penalize you. We will start by exposing the phantom tax that sneaks up on your Social Security, then uncover the hidden self-employment traps and Medicare cliffs that drain your savings. Finally, I will reveal the absolute biggest mistake, the earnings test clawback, and exactly how you can structure your side income to outsmart these traps completely. Let us begin with a silent wealth destroyer known in financial circles as the tax torpedo. When you start making extra money in retirement, you might assume you will simply pay standard income taxes on those new earnings, just like you did during your entire working career. But the tax code has a very specific, highly punitive formula for retirees that can turn a modest side income into a massive tax liability. This happens because of the way the IRS calculates the taxes on your Social Security benefits, using something called provisional income. Provisional income is a unique formula the IRS uses exclusively to determine how much of your Social Security is subject to federal income tax. To find this number, the IRS asks you to take your adjusted gross income, add in any non-taxable interest you might be earning from things like municipal bonds, and then add exactly 1/2 of your total Social Security benefits for the year. If that combined number crosses certain thresholds, suddenly your previously tax-free Social Security benefits become taxable. The thresholds for this tax trap have not been adjusted for inflation in decades. Congress established the first set of rules back in the 1980s, declaring that if a single filer's provisional income exceeded $25,000, up to 50% of their Social Security could be taxed. A decade later, they added a second tier, stating that if a single filer crossed $34,000 or $44,000 for a married couple, up to 85% of their benefits could be taxed. Because these numbers were never pegged to inflation, what was originally designed as a tax strictly on the wealthiest retirees is now capturing average middle-class seniors who are just trying to keep their heads above water. Here is exactly how the tax torpedo fires when you take on a side hustle. Imagine you and your spouse have carefully managed your income so that your provisional income sits right below the $44,000 threshold. You are paying very little in taxes. But then you decide to start driving for a rideshare service, or you take on a part-time consulting gig, or you start selling crafts online. You bring in an extra $10,000 for the year. You might think you will just pay a 10 or 12% tax on that $10,000. But instead, that extra $10,000 pushes your provisional income deep into the 85% taxable bracket. Now, not only are you paying standard income tax on the $10,000 you earned from your side hustle, but that side hustle has triggered taxes on $8,500 of your Social Security benefits that were previously tax-free. You are essentially being taxed twice because of one single stream of new income. Your effective marginal tax rate can easily spike to over 40%. You worked all those extra hours, dealt with all that extra stress, only to hand nearly half of it back to the government simply because you crossed an invisible, outdated line in the tax code. To protect yourself from the tax torpedo, you have to fundamentally change how you view extra income. You must become hyper-focused on your adjusted gross income. Every dollar you can legitimately deduct from your side hustle reduces your adjusted gross income, which in turn reduces your provisional income, which ultimately rescues your Social Security benefits from being taxed. This means you cannot just treat your side gig like a hobby. You have to treat it like a meticulous business. This brings us to the next massive blind spot for retirees making extra cash, which is the severe misunderstanding of how the IRS views independent contractors. When you worked for an employer, you probably rarely thought about payroll taxes. Your employer automatically deducted your share of Social Security and Medicare taxes from your paycheck, and importantly, your employer paid the other half on your behalf behind the scenes. You only ever saw the net amount that hit your bank account. But when you step into the world of gig work, consulting, or freelancing in retirement, you are no longer just an employee. In the eyes of the Internal Revenue Service, you are a business, and businesses are responsible for the full burden of those payroll taxes, which is known as the self-employment tax. This tax is currently 15.3%. That consists of 12.4% for Social Security and 2.9% for Medicare. Consider how devastating this can be if you are not prepared for it. Let us say you earn $5,000 over the holidays doing freelance work. You might mentally earmark that entire $5,000 to pay for property taxes or a family vacation. But the moment you file your tax return, the IRS is going to assess a 15.3% self-employment tax right off the top, which is $765. And that is before you have paid a single penny of federal or state income tax on those earnings. Suddenly, the extra cash you thought you had is dramatically reduced. And if you have not set that money aside in advance, you are going to find yourself writing a painful check to the IRS on April 15th. Did you know that the IRS estimates over 30% of gig workers and freelancers misreport or severely underpay their taxes simply because they do not understand the independent contractor classification and the hidden burden of self-employment taxes? The landscape of tracking this income has also changed aggressively in recent years. In the past, people who worked odd jobs or sold items at flea markets operated in a gray area, often paid in cash, and leaving the IRS entirely in the dark. But those days are completely over. The IRS has implemented strict reporting requirements for third-party payment networks. If you use services like PayPal, Venmo, or Cash App to receive payments for your goods or services, those platforms are legally required to report your earnings directly to the IRS by issuing you a Form 1099-K. The moment that form is generated, the IRS computers match it against your tax return. If you fail to report that income because you thought it was just a casual side hustle, the automated system will flag your account and issue a CP 2000 notice. This is a letter proposing additional taxes alongside substantial penalties and interest. Receiving one of these notices is a deeply stressful experience, especially in retirement when your cash flow is heavily managed. The IRS is hoping you ignore the administrative side of your side hustle because it makes it incredibly easy for them to assess these automated penalties. To navigate this self-employment trap safely, you must proactively manage your quarterly estimated taxes. When you have a W-2 job, taxes are withheld from every single paycheck, satisfying the IRS requirement that taxes are paid as income is earned. The American tax system is a pay-as-you-go system. But as an independent contractor, no one is withholding those taxes for you. It is entirely your responsibility to estimate what you will owe and send those payments to the IRS 4 times a year in April, June, September, and January. If you wait until tax season the following year to pay what you owe on your side hustle, you will be hit with an underpayment penalty. This penalty is not a slap on the wrist. It is calculated based on current interest rates and how much you fell short throughout the year. It quietly eats away at your hard-earned profits. To avoid this, you need to utilize the safe harbor rule. The IRS says that to avoid an underpayment penalty, you must pay either 100% of the tax shown on your previous year's return or 90% of the tax you will owe for the current year. If you are considered a high-income earner, that 100% threshold jumps to 110% of last year's tax. Setting aside 25 to 30% of every dollar you make from your side hustle into a separate high-yield savings account specifically designated for quarterly taxes is the most effective way to shield yourself from this stress. Now we need to address a trap that is so financially destructive it can wipe out a year's worth of side hustle profits in a matter of months. This is the Medicare Income-Related Monthly Adjustment Amount, commonly known as the IRMAA Cliff. Medicare Part B, which covers your doctor visits, and Part D, which covers your prescription drugs, both have standard baseline premiums that most retirees pay. However, the government heavily subsidizes these programs for the average American. If your income rises above certain thresholds, the government starts pulling back those subsidies, forcing you to pay significantly higher monthly premiums. The most dangerous aspect of the IRMAA surcharge is that it is not a gradual phase out. It is an absolute cliff. If your modified adjusted gross income is even one single dollar over the threshold, you are catapulted into the next surcharge tier for the entire year. Let me paint a picture of how devastating this can be. Imagine you are safely under the threshold, but near Near the end of the year, you take on a rush project for your consulting business that pays you $1,000. That extra $1,000 pushes your total income just $2 over the IRMAA limit. Because of those $2, your Medicare premiums for both you and your spouse could increase by thousands of dollars for the year. You literally lose money by working that extra job. You traded hours of your retirement to make $1,000, and the government penalized you $3,000 in increased healthcare costs. It defies basic logic, but it is the harsh reality of the current tax code. What makes the IRMAA cliff even more insidious is the time delay. The IRS and the Social Security Administration look at your tax return from 2 years prior to determine your current Medicare premiums. That means if you start a highly successful side hustle in the year 2026, you will not see the penalty until the year 2028. By the time that massive premium increase hits your Social Security check, you might have already shut down the side hustle, meaning you have to pay those higher premiums on a reduced fixed income. It is a delayed financial time bomb that catches millions of retirees completely off guard. Shielding yourself from the IRMAA cliff requires extreme precision near the end of the year. If you project that your side hustle income is going to push you anywhere near an IRMAA threshold, you need to actively suppress your income before December 31st. You can do this by deferring payments from your clients until January, accelerating your business expenses by buying supplies or equipment before the year ends, or utilizing charitable giving strategies like a qualified charitable distribution if you are of the appropriate age. The goal is to aggressively manage that final number on your tax return so you do not accidentally step over the cliff for the sake of a few extra dollars. Now, everything we have covered so far about the tax torpedo and Medicare surcharges is devastating enough, but none of it compares to the absolute biggest financial shock that catches early retirees completely off guard. It is a rule so heavily misunderstood that I have seen it wipe out entire months of income in the blink of an eye, and we are going to break it down right now. This ultimate trap is the Social Security earnings test. When most people claim Social Security early, typically at age 62, they often do so with a plan. They realize the monthly check is not quite enough to live comfortably, so they decide to get a part-time job or start a side hustle to bridge the gap until their investments grow or until their spouse retires. It seems like a perfectly logical, responsible plan, but the Social Security Administration has a very strict rule for anyone who claims benefits before their designated full retirement age, which is usually between age 66 and 67, depending on the year you were born. If you are under your full retirement age and you earn income from working, you are subject to the earnings limit. For the current year, this limit allows you to earn a little over $22,000 without any penalty. But the moment your earned income surpasses that limit, the trap snaps shut. For every $2 you earn above the limit, the Social Security Administration will withhold $1 of your benefits. Let us walk through exactly what this looks like in the real world. Imagine you claimed early benefits at age 62, receiving $18,000 a year from Social Security. To make ends meet and pay for rising grocery and utility bills, you start a successful home renovation consulting gig. You have a great year, and you make roughly $42,000 from your side hustle. This means you are $20,000 over the earnings limit because the rule dictates they take $1 for every $2 you are over the limit. The Social Security Administration will penalize you by $10,000. But they do not just send you a bill. They literally halt your monthly checks. They will completely stop sending you your Social Security payments for more than half the year until that $10,000 penalty is entirely recouped. Stop and picture this for a second. You go to your mailbox or you check your bank account on the day your Social Security deposit is supposed to clear, and the balance is exactly zero. There is no warning phone call. There is just a sudden, catastrophic halt to your expected income. You took on the side hustle to get ahead, but because of the earnings test, your total cash flow for the year barely changed, and now you are exhausted from working 40 hours a week with nothing extra to show for it. The psychological toll of this specific penalty is immense. Many retirees panic, assuming they have permanently forfeited their benefits or that they have committed some sort of fraud. Now, to be completely accurate, this money is not technically lost forever. Once you finally reach your full retirement age, the Social Security Administration will recalculate your monthly benefit upward to account for the months they withheld your checks. Over the course of the rest of your life, you will theoretically get that money back in the form of slightly higher monthly payments. But that mathematical recalculation does not help you pay your heating bill today. It does not help you buy groceries this month. The immediate cash flow crisis caused by the earnings test clawback forces many early retirees to drain their savings or rack up credit card debt, completely defeating the purpose of taking on the side hustle in the first place. The only way to navigate the earnings test, if you are under full retirement age, is to aggressively monitor your net earnings from self-employment. Notice that I said net earnings. If you are an employee at a hardware store, the earnings test looks at your gross W-2 wages. But if you are running your own side hustle as an independent contractor, the earnings test only looks at your net income after your business expenses are deducted. This presents a massive opportunity for the educated retiree. By deeply understanding allowable business deductions, you can legally suppress your net income to stay under the earnings limit, allowing you to keep all of your side hustle money and all of your Social Security benefits. This is where the difference between tax evasion, which is illegal, and tax avoidance, which is your right as a citizen, becomes absolutely critical. If you are consulting, driving, or selling products, you must track every single mile you drive for a business purpose. The IRS standard mileage rate is one of the most powerful deductions available, often wiping out a huge percentage of taxable income for gig drivers. If you use a portion of your home exclusively and regularly for your side hustle, you must claim the home office deduction. A percentage of your mortgage interest, property taxes, utilities, and internet bill can be converted from personal expenses into legitimate business deductions. If you buy a new laptop to manage your online store, that is a deduction. If you pay for specialized software, marketing materials, or professional continuing education, those are deductions. You must keep immaculate records. Do not rely on shoeboxes full of faded receipts. Use a dedicated business bank account and a simple digital tracking tool. The goal is to maximize every single legal deduction so that your net profit on paper remains below that critical $22,000 earnings test limit, below the IRMAA cliffs, and below the thresholds that trigger the tax torpedo. The IRS is banking on your complacency. They rely on the fact that the transition from being a W-2 employee to a retired independent contractor is complicated, intimidating, and exhausting. They collect billions of dollars in underpayment penalties, self-employment taxes, and Medicare surcharges simply because older Americans do not realize the rules of the game have completely changed the moment they stopped punching a traditional clock. You do not have to be a victim of these bureaucratic traps. Making extra cash in retirement should be a source of security, freedom, and pride, not a source of anxiety and unexpected debt. By understanding how provisional income impacts your benefits, by preparing for self-employment taxes and quarterly payments, by aggressively monitoring your income to avoid the Medicare cliff, and by legally maximizing your deductions to sidestep the early retirement earnings test, you can build a financial fortress around your side hustle. We have covered a tremendous amount of ground today. We exposed how the tax torpedo can push your tax rate above 40%. We detailed the dangers of ignoring quarterly self-employment taxes. We highlighted the catastrophic $1 threshold of the Medicare IRMAA cliff, and we broke down the hidden cash flow crisis caused by the Social Security earnings test. Protecting your retirement income requires vigilance, but more importantly, it requires action based on the right information. I want to hear directly from you about how these rules are impacting your life right now. Drop into the comments below and tell me your experience. Have you ever been blindsided by a tax bill from a side hustle? Or have you found a specific strategy that successfully kept your extra retirement income safe from the IRS?